they actually have an index against which they're going to be judged, and that's an ETF, right? Now Bitcoin is part of how they're going to be graded. And while no major platform has yet put any of the spot Bitcoin ETFs on its platform yet, we think that's coming. We can tell from the kinds of questions they're asking. They're asking deep questions, not only about Bitcoin itself, but about infrastructure, ops, risks. And so the heat is on because...
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
This is a new asset class. Bitcoin is a new asset class. It's a monetary system, to be sure, but it also represents a new asset class. And what that means in our world is that as a fiduciary, someone looking after portfolios for people, a fiduciary has to consider a new asset class because of the low correlation with other assets in terms of returns and risk. And so if you add Bitcoin to an existing portfolio, if that is right, and this is low correlation asset, what that means is over time, returns per unit of risk will go up. So if one platform has Bitcoin and offers that opportunity of diversification,
Bitcoin has increasingly become recognized as a new asset class in the financial world. One of the primary reasons for this is its low correlation with traditional assets such as stocks, bonds, and commodities. This unique characteristic of Bitcoin provides significant diversification benefits for investment portfolios. Unlike traditional assets that tend to move in similar directions based on market conditions, Bitcoin's price movements are often influenced by different factors. This means that when the stock market is down, Bitcoin might still perform well, or at least differently, thereby reducing overall portfolio risk. Consequently, investors are starting to see Bitcoin not just as a speculative asset, but as a strategic component in a diversified investment strategy. This recognition has further solidified Bitcoin's position in the financial markets, making it a valuable addition for those looking to enhance their portfolio's performance and resilience.
And higher risk-adjusted returns, and another doesn't, then they're going to have a problem if this one's right. The ETFs are a wonderful structure. They can scale. We've got an ecosystem. This is not just the 10 companies or how many are still in operation. I don't know if any. I don't think any has outright failed yet. But the ecosystem, the structure is extremely flexible because the authorized participants, the market makers, are not inside one firm. We have dozens of authorized participants, and those are the big brokerage houses. So this is another reason they're being not forced into this, they're being lured into this, because the ecosystem, authorized participants, market makers, is a very lucrative ecosystem, and these wirehouses host many of them. So I think, we could scale to hundreds of billions of dollars.
The scalability of exchange-traded funds, ETF, structures represents a significant feature that contributes to their increasing popularity and potential for substantial market growth. The inherent flexibility of ETFs allows them to adapt to a wide range of market conditions and investor needs, making them a versatile investment vehicle. This adaptability is crucial as it enables ETFs to accommodate various asset classes, investment strategies, and market environments. Consequently, ETFs have become a cornerstone of modern investment portfolios. One of the key aspects of ETF scalability lies in their structural efficiency. ETFs are designed to be easily scalable, meaning that as investor demand increases, additional shares can be created without fundamentally altering the underlying structure of the fund. This scalability is facilitated by the creation and redemption process, where authorized participants can add or remove shares to match investor demand without impacting the ETF's price or performance. This process ensures that ETFs can handle large inflows and outflows of capital without significant disruption, making them a robust option for both retail and institutional investors. Moreover, the growth potential of ETFs is underscored by their ability to innovate and introduce new products that cater to evolving investor preferences. The ETF market has seen a proliferation of specialized funds targeting niche sectors, thematic investing, and alternative asset classes. This innovation is supported by the flexible nature of ETFs, which allows fund managers to design products that meet specific investment goals and risk profiles. As a result, ETFs can attract a diverse range of investors, from those seeking broad market exposure to those looking for targeted strategies. In addition to their flexibility, the scalability of ETFs is also enhanced by their cost-effectiveness. ETFs typically have lower expense ratios compared to mutual funds, making them an attractive option for cost-conscious investors. This cost efficiency is a result of the passive management style employed by many ETFs, which aims to replicate the performance of a specific index rather than actively managing a portfolio of securities. The reduced costs associated with ETFs contribute to their scalability, as they can offer competitive returns while keeping expenses low. Furthermore, the liquidity of ETFs plays a vital role in their scalability. ETFs are traded on stock exchanges, providing investors with the ability to buy and sell shares throughout the trading day at market prices. This liquidity ensures that investors can enter and exit positions with ease, which is particularly important during periods of market volatility. The continuous trading of ETF shares enhances their appeal, as it offers a level of flexibility and accessibility that is unmatched by many other investment vehicles.
Oh, the read was it was not going to be approved. It was absolutely not going to be approved. So what happened? If it were to have been approved the regular way, we would have been getting questions, meaning from the SEC. And no one was getting questions from the SEC beforehand. So that was an indication, no go, just, we'll have to try it again. What happened in 1 week's time, and I truly believe this was one of the things that happened, is there was sentiment evolving around this FIT 21 Act in the House that, wait a minute, this thing is gaining momentum on both sides of the aisle. And wow, this could be an election year issue. This is an election year. So the administration, I think, basically said, oh, and the other thing that happened was former President Trump has become much more cozy with Bitcoin, crypto generally, and that week said he would accept campaign donations in crypto. So again, this idea, this is an election year issue. And then I cannot tell you, I was on the phone with our COO, and he was like, he screamed when he saw this come across, like, what? It was within 3 days of being denied. We were sure. We were sure it was going to be denied. And I think it was this campaign election year. You've got the legislative branch. You've got former President Trump. You had, rapid fire, and boom, here we are.